When it comes to retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated like a number. This is your retirement. So it's time to think differently. And you're in luck because you found the Retire Your Way podcast with Dave Lopez, founder and managing member of ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement plan at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now. Thank you so much. Coming to you from the ILG Financial Studios, this is Retire Your Way, the podcast that gives you straight talk and honest answers about how to achieve your financial goals through smart investing and careful planning. Glad to have you along with us today. We have some valuable information for you that could change your financial life for the better. My name is Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and the solid advice comes from Dave Lopez, founder and chief investment officer of ILG Financial. How you doing today, Dave?
I'm doing good and glad to be with you as always. It's good to be together, and I think we've got a very timely show today. I think I'm looking forward to having this discussion with you.
And likewise too, Dave, always glad to be with you. And right, today's show is going to be timely. And as we're recording this show, this being a podcast, we're recording on March 20th, so we're going to be talking about how things stand today. But of course, this coronavirus outbreak and the effect that it has on the economy can change from day to day, week to week. So we're going to give you some information that we think that you can use no matter what stage this is in. First of all, Dave, I know that your clientele is probably a little concerned about the coronavirus. What have you been hearing from your clients?
Now, that's a good question. One of the things I told my staff is that this is going to be one of those when the rubber hits the road, is we're going to be able to assess how good a job we've done in building the plans and, more importantly, in communicating what they could expect in the future. From previous podcasts, if you remember, what we talked about is when we build out plans for our clients, Jeff, one of the things we do in our 5-step process is a portion that we call the due diligence process. Do you remember us talking about that?
Yes, I do, as a matter of fact.
Yeah, and for those who hadn't listened to that podcast, it's worth going back and listening to our 5-point plan building process. But in the due diligence process, we've now built the plan, and then what we do is we literally try to make the plan fail. We talk about things like, well, what if the stock market goes through the roof over the next 10 or 20 years? What if the market crashes and doesn't come back for 5 or 10 years? What if interest rates go up? What if interest rates stay down? All these economic events that have happened in the past, we literally run them through a filter and discuss. Now, we can't, of course, guarantee how the plan's going to perform, but we can make some very good educated guesses based on how they're invested. And our point was, when we do this due diligence, whenever I talk to them about market corrections, one of the things I say is, of course, I can't guarantee this, but you really want to build this plan out. Assume we are going to have them. We're going to have little ones and we're going to have major ones. And the reason I'm confident talking about that is if you look back historically at the market, going all the way back to the 1900s, the market has never gone up forever. It's always corrected. And to date, it's always over time recovered, right? Now, the recovery time sometimes is 4 years, sometimes it's 26 years with the Great Depression. With that said, what I told my team is this will be interesting to see how many calls we get that are panicked or upset versus how many calls we don't get. Well, what was interesting is compared to other advisors we've talked to, we are getting surprisingly few calls and emails, and most of them are, hey, I know we built this into the plan, but I just need a little reassurance. Now, for us, that was a huge win because it means that we accurately articulated the fact in advance when times were good that things are not going to be good forever, right? And that we built the plan in. So what we've been doing on our calls, Jeff, is really just running through their plan again and saying, hey, we talked about this 6 months or a year ago. Well, here we are, right? The market's correcting. And let's take a look at if this is performing as we predicted it would perform so we can get a good idea of what we expect moving forward. So we're very happy with that. And I think it's, you've heard that old phrase, you reap what you sow. right? So I think that for advisors, this is where the rubber meets the road, and all advisors are going to reap what they sow. If they've done a good job of building out a plan and anticipating the market's going to perform like it always has, which is up and down, and they built a plan that's in their client's best interest based on their goals, then, no one likes losing money, but they can see that, hey, the plan still ideally is going to work because it's performing at least as we designed it to. And more often than not, that's what we're seeing. And that's a positive thing.
So you're stress testing these plans. You're putting in some defensive strategies so that if it's a minor market downturn, of course, the plan can withstand that. But you also put a defense in there in case something drastic happens like this as well?
Yeah, we sure do. So let me give you a great example. I don't want to get too much into numbers because my staff, when they listen to the podcast, they say, listen, remember, Dave, people can't see you. So when you just start throwing numbers out, it's a lot like when you get lost in Washington, D.C. and you ask somebody for directions. And if you're like me, Jeff, after 2 turns, I'm lost. So I just pretend I'm understanding and nod to be polite, right?
Right.
So it's the same thing with numbers. But in general, I'll give you a great example. Let's say, Jeff, that you needed to retire and you had $100,000 and you needed to take out, $1,000 a month to live off of. Well, what we might do is position some of your money over in vehicles that don't go down if the market corrects. That way it doesn't matter in the future if the market corrects or not. You could still take your $1,000 out. As much as if it was $100,000, you could take it out for almost 8 or 9 years, right? Whereas you had another $100,000 that we might put in the market because we could say, hey, we safely don't need that money for 12 or 8 or 9 years because we've got another bucket for income, right? So in that scenario, half your money is on a principal protected bucket that didn't go down at all. And even if the other half lost 35%, which is about where we are today, well, that bucket lost 35, but the other bucket didn't lose any. You're only down about 15%. But more importantly, the bucket that's down, you don't need to touch for 8 years. Make sense?
Absolutely.
So you could give it a chance to recover. And more often than not, recoveries, there's been several that have taken longer than 8 years, right? But for the most part, by 8 years, we're usually back. But again, we can craft that to where someone could have 10 years or 12 years, or some plans we build out so the money that they have in the market, they never need for income. So they could leave it 15 years if they needed to. And that gives people a lot of peace of mind. Where people have anxiety is if they're counting on the stock market bucket for income. And we talked a little bit about that in previous podcasts with what we call sequence of return risks. Do you remember that talk?
Absolutely, Mr. Brown and Mr. White.
Mr. Brown and Mr. White, right. So this is a perfect example, right? And we talked about, and a lot of folks dismiss it, and a lot of advisors dismiss it after 11 years of an up market, but now you're seeing it, right? If you had $100,000 and you said, hey, I'm averaging a 5 or 6% return, so I can take out $5,000 a year to live off of. Well, now, not only are you not getting a 5% return, you've just lost 35% of your money. Now your $100,000 is $65,000, right? If you try to take $5,000 out now, you're taking out almost 9% of your bucket. Well, what if the market stays down for 5, 6, 7 years? That's $65,000 and it's still losing money and you're taking $5,000 a year out, you could quickly run out of money. And then even if down the road, 5 or 6 years from now, the market recovers, you don't because you're now out of money.
That's Dave Lopez of ILG Financial. You're listening to Retire Your Way with Dave Lopez. And we're going to take a quick break, Dave, about 60 seconds or so. When we come back, we'll continue to talk about how we're coping with this coronavirus and more when our show continues right after this.
You're one step closer to learning what a customized retirement strategy can do for you. Stay tuned for more of ILG Financial's Retire Your Way podcast with Dave Lopez.
When it comes to something really important, like your retirement planning, have you ever felt like people are talking at you instead of to you? Things are different at ILG Financial. We understand that there's a person, a story, and a lifetime of hard work that built that nest egg, and we never forget how much is riding on it. At ILG Financial, we think differently about your retirement because it's supposed to be all about you, not just your portfolio. That's why we work with you to integrate your lifestyle goals into our comprehensive retirement planning process, because we believe it's possible to have financial security and still pursue the things that make you happy. We'll show you how your lifestyle goals can help shape your income and investment plan as part of our retirement planning process. If you're ready for a different approach to retirement planning, call us today for a complimentary consultation at 540-720-5656. That's 540-720-5656. Or go online to ilgfinancial.com. Investment advisory services offered through AlphaStar Capital Management, LLC, a registered investment advisor. AlphaStar and ILG Financial are independent entities.
Income, legacy, growth. It's all right here at ILG Financial. And it's about helping you plan for retirement your way so you can achieve your financial goals. Call ILG Financial at 540-720-5656 or go online to ilgfinancial.com to learn more. Now back to the Retire Your Way podcast with Dave Lopez.
Welcome back to Retire Your Way with Dave Lopez, our podcast being recorded on March 20th. And keep in mind that we're talking about things as they are on the date March 20th. Things, of course, are changing day by day and week by week, but we think the advice that we're talking about here is good for really almost any time and, any part of this particular downturn. Dave, let's recap a little bit about what we've just talked about in the last segment.
Sure. The big picture of what we're talking about is, the words you hear with stuff in the market is don't panic and, of course, don't sell when the market's down. That is all very good advice, but it's very general advice. The big picture is, and we've been talking about this for years, right, which is you just want to make sure, and now's a good time to double check it, that the money that you've got invested in the market, because it can go up or down, as we're seeing, should be money that you're prepared to leave a minimum of 10 years if necessary, so that if there's a market correction, it can recover. If you have money that you need for income or any other expense or emergencies when you don't know when they're going to happen, like a long-term care need or something like that, that money, in my opinion, probably shouldn't be in the market. And what's going on today, as of March 20th, is a perfect example of why, right? We can't guess that when I need that money isn't going to be a time like this when I just lost 30 or 40%. So there's absolutely a place in your retirement for stock, bond, things that fluctuate up and down. It's just you want to use the right bucket. And meaning, what's the goal of that bucket? Stuff that you can leave long term, not stuff where you're taking out money in sequence, for example, monthly payments, or stuff that you might need for an emergency fund and you can't time it with the market.
That's exactly right, Dave. And I think this is also a wake-up call for those people who maybe have not assessed their risk tolerance lately. It depends upon how you feel about this. If you've got too much money in the market, of course, you are suffering a bit at this point in time. And I think your risk tolerance and the amount of money that you have in the market would vary depending upon your age. So let's talk about that a little bit. Let's say that I'm 5 years out from retirement right now as opposed to at the cusp or in retirement. The market is sort of like riding a roller coaster. It's sort of like the rebel yell there at King's Dominion. When I've been on that roller coaster, I never thought about getting off of it mid-ride. I usually waited until it stopped. So if I'm 5 years from retirement, should I just keep riding the roller coaster?
Yeah, that's a great question. So I can't answer that on the radio, unfortunately, or the podcast, because it's specific to every person. But so let's just talk general. Here's some data to be aware of. This roller coaster that you're talking about, and I can't think of a better analogy for it. If we go back all the way to 1980, the Dow Jones was at 2,500 in 1980. In 2020, it just dropped to just under 20,000. But you're talking 2,500 to 20,000. That's a huge upswing from 1980. Now, in that period, we have had 6 bear markets, that's down markets like we're seeing right now, and we've seen 6 bull markets where it's, roaring up. That's going up the roller coaster. So it goes up and down, but over long periods of time, this roller coaster goes up. So the takeaway to your question, and I know I'm long-winded getting there, I apologize, that's one of my faults, Jeff, but your question was, hey, I'm 5 years from retirement. Should I be in the market? Correct? Is that the question?
That's it, and I like when you pontificate here, so it's not a fault. I like hearing the details.
Good. Call my wife and tell her that, because she does not like when I pontificate.
Okay, right? I'll do that.
So if we're on this roller coaster, I think that's a great explanation, right? Let's say the roller coaster would really run for 20 years, right? And at the end of 20 years, you knew it pulled back into the station and you could safely get off, regardless of how many ups and how many downs you had in the middle of that 20 years. So the question is, if you can commit to riding the roller coaster for the entire 20 years, then it doesn't matter how many ups and how many downs you have, because you know you can get off in 20 years and safely walk out, in this example, without losing money probably. Agreed?
Agreed, my friend.
Right, but if you have to get off in 5 years and the coaster runs for 20, you don't know if in that 5-year period you're going to be at the very top of the hill, which would be an ideal time to get off, or if you're going to be in the middle of the drop on the, I think our roller coaster here is, I'm locating myself, but here in Virginia, the big one's King's Dominion, and the oldest one at King's Dominion I've been riding since I was about 10 years old was the Rebel Yell. And it was all made of wood. It was an old-fashioned one. It's still there, and we love it. But, of course, lots of up and down. So if you're on the Rebel Yell and we're at the very peak and it's time to retire, well, things couldn't have gone better for you, right? You step off at the very top and you avoid this huge drop when you have all your money in your pocket and you can use it for retirement. That would be equivalent to roughly February 15th, right? Before we heard anything of the coronavirus, the market was at an 11-year high, the top of the roller coaster. If you needed to retire, in this example, just 60 days later, now we've already gone over the cliff and we are flying down at a huge descent and we're literally losing money every day. We're seeing it. Well, that's a horrible time to be saying, now I'm going to retire and start pulling money out of my account. The point being is you can't time, we don't know in advance, like with a roller coaster, when the ups and when the downs are coming. And this virus situation that we've had in this last 3 weeks, I cannot think of a more appropriate analogy to show people that you don't get this long window of when a recession's coming. When it's something like this, by, the way, is called a black swan event. It means no one saw it coming. Another example was the BP mess with the Gulf when the oil was spilled. One day you're fine, something happens that night, and all of a sudden the world changes. So your question was, what should we do if we're 5 years out? Well, my recommendation for most folks is if this is money that you need in 5 years, historically, we don't have a good feeling that you're necessarily going to be able to recover from a market correction in 5 years. You may and you may not. So that's probably money I wouldn't want in the market. I can put that in other vehicles that can give us more principal protection or safety or more even guarantees for income down the road. And we talked a little bit about those. In future podcasts, we'll talk about things like that. But I'll just give you an example. A fixed indexed annuity, you can put money in and you can say, listen, I want this money, as far as the income's concerned, to literally grow every year so that the check goes up every year I wait to turn it on, just like Social Security. And then regardless of what's going on in the market, when I hit that retirement date, I know in advance what my check's going to be. So we can do income planning for our clients, Jeff, with Social Security, pension, things like fixed indexed annuities, where we can literally tell them this is exactly how much money that you're going to have coming in, whether the market corrects or not. Now, that enables you to take other money that you don't need for income, and that money could be in the market because it doesn't matter if the market goes up or down. We're getting our income, and we can let that money sit.
Sounds like a good plan, Dave. I appreciate you pontificating there, and I'll call Cheryl and tell her it's okay. I like to hear Dave talk. If you want to hear Dave talk to you about your finances and maybe make you feel a little bit better, I invite you to get your complimentary plan. Dave's offering it, of course, no charge, no obligation whatsoever. To get yours, call 540-720-5656, 540-720-5656, and, of course, peruse the website, ilgfinancial.com. Dave, I appreciate your time here talking about the coronavirus and how it affects the market, and we'll continue our conversation here in the near future about that, and hopefully the next time we talk about it, that things will be just a little bit better. For Dave Lopez, I'm Jeff Shade. Have a great day. Thanks for listening. We'll talk to you again another time here with another edition of Retire Your Way. Have a great day.
The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and not necessarily represent the views of AlphaStar Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through AlphaStar Capital Management, LLC, an SEC-registered investment advisor. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. AlphaStar and ILG Financial, LLC are independent entities.